the class, we are going to try and complete the question we started. That was the question on bond valuation. We are looking at question number 4. Let me go to the material again. I can see a side comment that this thing is better in the physical class. Maybe because you have not done online class before. Although I know some people have preference for physical class, no problem. Now let's go straight to the question because we only have 2 hours there. Let's go straight to that question. Question number 4. I'll read again quickly. The following information is on 3 default-free bonds. We have bond ABC. We have the price of the bond. We have the coupon rate. We have the redemption value, and we are giving the maturity. Bond A is for 1 year maturity. Bond B is for 2 years maturity, and bond C is for 3 years maturity. Now, we explained that what is default-free bond? Please note, default-free bond is government bond. Bond where there is no risk of default. So these 3 bonds, bond A, B, C, are government debt instruments because there is risk-free, there's default-free. Now the question number A part says we should estimate the 2-year forward rates at the end of year 1 and the 1-year forward rates at the end of year 2. This we treated in the classroom. We are supposed to be looking at the B aspects of this question. Of course, we can't go back to the A because the time spent in even doing the A might take 1 hour. So we move to the B part. The B part says you are considering, let me move this up a bit. Oh, I don't like this. Okay, let me also expand this. Just 1 minute, please. Okay. You are considering buying 3-year bond. You are considering buying a 3-year 9% annual coupon paying bond with a face value of 1,000. The bond is a default-free bond. That means this bond is government bond. Are you there, please? You are looking at buying a 3-year 9% coupon bond with a face value of 1,000 naira. The bond is a default-free bond. Now, requirements B1 says, calculate the price of the bond and its yield to maturity. Clearly explain why you may not realize the calculated yield to maturity. We take that question again. Calculate the price of the bond and its yield to maturity. That means in that B Roman figure 1, I'm going to do 2 things, 2 calculations. I'm going to calculate the price of the bond. That is the market price of the bond. I'm going to calculate the yield to maturity. Now, the next question is, how do we calculate the price of a default-free bond? That is government bond. You are going to now ask yourself, this bond is a redeemable bond? or convertible bond or irredeemable bond? You are going to ask yourself this question again. The bond you are trying to calculate the price. Is the bond a redeemable bond or a convertible bond or an irredeemable bond? If you look at this question, you are considering buying a 3-year bond. That means this is a redeemable bond. A bond with a specific repayment date. That means I'm dealing with a redeemable bond. Now the next question again is, how do we calculate the price of a redeemable bond? If you recall, to calculate the issue price of a redeemable bond, this is calculated as the present value of the expected future cash flows associated with the bond. I'll take that again. To calculate the issue price of a redeemable bond, this is calculated as the present value of the expected future cash flows associated with the redeemable bond. This bond will be discounted by these cash flows will be discounted by the bond yield. That is government spot yield curve. Because this bond is a default-free bond, if I'm going to discount this bond, I'm going to look for government spot yield curve. If you recall, we emphasize that government spot yield curve is the interest rate on government bond. These rates can only be used to value government bond. Now, this question is about valuation of government bonds. We have tried to explain this to enhance understanding. The purpose of this explanation is to make it easier for us to understand the solution we are dealing with. Haven't I explained this? We are going to move to the whiteboard now. Any question? Okay, we shall move to the whiteboard now to start the solution. Let me say that it's not a crime if you write down, if you are taking down notes or you copy. Although at the end of the class, the solution will still be shared with the students. All right. Please confirm you can see my whiteboard being shared.
Yes, we can, sir.
All right. So that person that say it's better to go to physical class, but we have explored different alternatives. Now let's go to this. Badmos. Physical class is better, Avi. You know the cost of coming to physical class now. All right, let's go to this solution. B1. You want to calculate price of the bond. The first thing I normally do is to itemize the features of the bond. That is the characteristic of the bond. Let's look at the features of the bond. 1, maturity. The maturity of this bond is 3 years. The maturity of this bond is for 3 years. Number 2 is the coupon rate. The coupon rate is 9%. Next is the face value. The face value of the bond is 1,000 naira. Then last is the redemption value. If you look at the question, we are not giving the redemption value. In this question, redemption value is not expressly stated. Now, please note, where the redemption value is not stated, you are going to assume that the bond will be redeemed at par value. Please note, where the redemption value is not stated, you are going to assume that the bond will be redeemed at the par value. The par value is the face value, 1,000. We have itemized the characteristic of this bond. Please, let us check our speaker so as to complete the class, except you want to ask questions. And you can do this either by sending your question or by indicating with your hand raised up. Any question, please? No. Now, I will now try to look for my working one now. As future cash flows. The future cash flows of the bond now, of the bond, this bond, of this bond now. One is the annual interest. Annual interest. I will shorten this. Like we explained, interest is calculated on the face value. 9% of 1,000. That will give us 90 naira. This will be in year 1. Annual interest again. Annual interest. Just 1 minute. Annual interest. 9% of 1,000. That will give me 90 naira again. This is year 2. Year 3, because the bond is for 3 years. The annual interest again. 9% of 1,000. That will give me 90, year 3. In year 3 again, we are going to get the redemption value. Redemption, the redemption value. The redemption value is 1,000 naira. This is year 3. This is also year 3. You observe that in year 3, you have 2 cash flows. You have the annual interest 90 naira. You have the redemption value 1,000. You are permitted to add these 2 together. That becomes 1,090 in year 3. We have gotten the expected future cash flows. Good enough, we have calculated the government spot yield curve. That is the spot interest rate we calculated in A. We recall, for those that were in class last week, please check your notes and give us the spot rate for year 1, year 2, year 3. For those in class last week, please look at your note and give us the spot rates, the spot interest rates. That is the government spot rate. Yes, we're speaking. Oh, government spot rates. Yes, we're speaking. Year one. Year one. I think we got 4.76%. Year two, we have 6.21%. Then year three, what do we have, please? In class last week.
Is it 7.867?
Give me the spot rates.
6.82.
Because, thank you. If you don't know, that means, look at your note. There's what we call spot rates. What you are giving me, that 7.8 is the forward rate. Do you understand? The spot rate for year three that we computed was 6.82%. This is the spot rate. We use the default free bond to compute the spot rate. When we got the spot rate, we now use the spot rate to calculate the forward rate. I remember saying that you can't compute your forward rate without knowing the spot rate. So this spot rate is the government spot rate. It is the rate on government bond. Like I explained, default risk, default free bond. These are government bond. And this rate was derived from default free bond. This rate will be used to value our bond now. We can now go to that valuation. We can go to the valuation. Let me move this up more. Would this place, okay. Now you have gotten the default risk, we have gotten the government spot rate. I can get the discount factor. Let me take that as working three. I can get the discount factor, working three. Let me take the year like this. Look at it. I have my year. I have the year. Year one, year two, year three. The spot rate, this is 4.76%. This is 6.21%. And this is 6.82%. Now get your discount factor. Your discount factor. Please get your calculator closer. Now, please, discount factor for year one at 4.76%. Please compute. Discount factor for year one at 4.76%. Please compute. What do we have, please?
$0.9545.
0.9545. 0.9545. Okay, let's take 55. Please, is there anybody in this class that doesn't know how we get the discount factor? Now for year 2, we are going to use 6.21. Discount factor for year 2 at the rate of 6.21. What do you have, please?
0.886.
886. Then year 3. Discount factor for year 3 at the rate of 6.82.
0.820.
820. I've gotten the discount factor. I have the cash flow. I can get the present value. The value of a bond, the price of a bond, is the present value of the future cash flows associated with the bond. I have the future cash flows. I have the discount factor. I can get the present value. I can get the price. We move to page 2. Please, we have moved to a new page. That's our page 2. I'll just come here. The price of the bond now, continue. The price of the bond. I open my table, I have the year. I'll pick my cash flow. I don't need to waste time. My discount factor. Okay, maybe for consistency. Let me just put it, maybe for consistency, because some might say, you didn't put this item. I have my item. I have the cash flow. I have the discount factor. They have the present value. I have year 1, year 2, year 3. Item, annual interest in year 1. Annual interest. Annual interest in year 2. Annual interest. In year 3, I have the annual interest. The annual interest plus the redemption value. Plus the redemption value. This is 90 naira, 90 naira, 1,090. The discount factor as computed 0.955, 0.886, 0.820. Please supply the present value. Cash flow multiplied by the corresponding discount factor. Just 18 students.
For the second year, 79.7. That's 78.
79.7.
Yes, for year 2.
79.7. Year 1 or year 3, anybody?
Year 1, 85.9.
85.9. Then year 3?
Year
3, 893.8.
893.8. Now sum up. Online class is sweet, so it's just because some of you have one condition. Online class is very sweet. The same thing we solve in the physical class, we also solve it here. Oh yeah, final answer. So sum up.
1059.4.
1059.4. That is the issue. That is the price of the bond. You are done with the price of the bond now. Next is your yield to maturity. You are done with the price of the bond. The next requirement is the yield to maturity of the bond. Any question, please? If there's no question, let us move to, you can't take this place. Let's take another board. So again, we have introduced the third whiteboard. We need to calculate the YTM of the bond. YTM of the bond. Please, what is yield to maturity? How do we compute yield to maturity? Yes, please.
IRR.
And what's that one? Okay, how do we compute yield to maturity?
We assume two discount factors, one to give us a negative, another to give us a positive.
Right, great. That's great. Okay, the yield to maturity of a bond is the internal rate of return of the cash flows associated with the bond. Please mark that sentence. So I didn't say future cash flows. Of the cash flows, both the present cash flow and future cash flow. The yield to maturity of a bond is the internal rate of return of the cash flows associated with the bond. The price of the bond is also part of the bond cash flow. So we go to it quickly. Open your table. You have the year 0, year 1. You can do year 1 to 2 because it's the same cash flow. Or you can also do it individually itself. Year 1 to 3. Your items. This is the price of the bond. Price of the bond. That is the price. Here I have annual interest. Here I have annual interest. Here I have interest. The annual interest plus redemption. Plus the redemption. Then my cash flow. The price of the bond, that is the price we calculated. 1059.4. In year 0, the price of the bond will be in brackets. If you are buying the bond, you are going to pay a price of 1059.4. That is an outflow. In year 1, you are going to receive interest of 90 naira. Year 2, you are going to receive interest of 90 naira. Year 3, you are going to receive both the interest and the redemption value. These are the cash flows associated with this bond. We now assume a discount factor or a discount rate. What are we assuming, please?
10 and 15.
We should start with 10. 10%. At 10% discount factor year 1, that would be 1. This will give me 0.909. This should give me 0.826. It should give me 0.751. Now get the present value first. This is 1059.4. 81.4. Please multiply. What do you have here?
81.81.
81.81. Next.
74.34.
74.34. Next.
818.59.
818.59 or 1.
9.
9. Now get your MPV. Let us know if it is positive or negative. MPV. Let us know if it is positive or negative. Yes.
Negative 84.66.
84.66. Negative. Now that means for me to get positive, I need to reduce this discount rate. Is that not? Is that not, please? So we can go to like 5, Abby. Let's take 5. All right. At 5%, what is the discount rate? This will give me 1. 0. What here, please? 0.9.
Sorry, sir, hold on. I think it's positive. Oh.
It's negative now.
It's negative.
Discount factor at 5%. Year 1.
0.952.
952. Next. 0.
0.
Your line is breaking.
907.
907.
Then
Next.
0.864. 864.
Now get your present value. This will give us 1059.4 in brackets.
85.66.
85.66. 68. Thank you. Next.
81.63.
81.23. 63. Next.
941.76.
941.76. Thank you. Please get the MPV.
It's 49.57.
49.57. Positive.
Yes.
We can now go to the YTM now. The YTM no, that's why. Let that come down. No, sorry, guys. It's this thing that is becoming so high. All right, YTM, if this one is not too high, is equal to positive. I'll start with 5 plus positive MPV 49.57 all over 49.57 plus 84.66 multiplied by 10 minus 5. Please find an answer. Find an answer.
6.8.
6.8. Yeah, that's correct. The YTM of this bond is 6.8. We have computed the YTM of the bond. Any question, please? Any question, please? All right.
Everything is clear.
Back to the question. Examiner says, clearly explain why you may not realize the calculated yield. You have calculated 6.8% as your yield to maturity. What are the reasons that can make you not to realize the YTM? Please look at the reasons. Look at the reasons. Let me expand this more. Number 1 point, timely receipts of the associated cash flows. Timely receipts of the associated cash flows. If the coupons and the redemption value are not received as and when due, the realized yield will be less than 8 is 8 point now. Will be less than 6.8%. If the coupons and redemption value are not received as and when due, the realized yield will be less than 6.8% because of the time value of money. That is the first point. Let's explain that briefly. The expectation is that you are going to receive your interest at the end of year 1. When you receive it, you are going to reinvest it. If you don't get that coupon interest at the end of year 1, if you don't get the coupon interest at the end of year 2, that means you cannot reinvest immediately. And that will affect your realized yield. Point number 2, reinvestment risk. If the coupon received at the end of year 1 and at the end of year 2 are reinvested at a rate lower than, it should be lower than 6.8%. Lower than 6.8%. The realized yield will be less than 6.8. And if they are reinvested at higher rates, the realized yield will be higher than 6.8. It will be 6.8. It's an error in their calculation. What we are saying is the assumption of yield to maturity is that you are going to reinvest your interest at the YTM. If you fail to reinvest the interest at the YTM, then your realized yield will not be the same as the yield to maturity. Then point number last, price risk. Price risk. If the bond is not hedged to maturity, that is year 3 in this case, the investor may realize capital gain or loss when the bond is sold to par. When the bond is sold prior to maturity. What that point is saying is, or the assumption of yield to maturity is that you are going to maintain your bond until the maturity. This bond is for 3 years. That means investor will not sell the bond. He's going to leave it until the end of 3 years. But if the bond is not hedged to maturity, the investor may realize capital gain or loss. By selling the bond prior to maturity, you can make a profit or loss, and that will affect the realized yield. So those are the reasons why the investor may not realize the yield calculated. And let me also say that this question is a bit shift from the usual bond question. Examiner introduced forward rates. Last diet was the first time forward rate was introduced. What it means is that the examiner is now texting forward rates. I will not be surprised if this diet, the examiner still repeat forward rates. Let me give you an hint how the exam is being texted. They will start with a particular topic now. That topic is very big. They might start with the first aspect of the topic. They will text that aspect for some time until they are satisfied that students can handle this aspect. They will now move to the other aspect of the topic. If you look at previous question on bond valuation, examiner always takes the area of spot rates, calculate bond value yield, duration, those are the same. Examiner has never texted forward rates. For the examiner to brought in forward rates, it's an indication that he's going to the other aspects of the syllabus, other aspect of bond valuation. What am I trying to explain? Please, whether it is tested or not, go with the knowledge of forward rate computation. All right? B2. We have treated B Roman figure 1. Look at B Roman figure 2. After purchasing, 1 year after purchasing the bond at the price you have calculated. 1 year after purchasing the bond at the price you have calculated, and if there are no changes in market interest rates, do you expect the price of the bond to increase, fall, or remain constant? Explain with 2 marks. To answer this question, for you to answer this question, you are going to look at the price of the bond. And you are going to look at the redemption value of the bond. Please allow me to go to that calculation. Where is that calculation? Okay. Okay. Or let me go to this first place. Okay, yes. Look at the price of the bond. The price of the bond is 1,059.4. That means the price is above the face value. The price is above 1,000 naira. It means that this bond is issued at a premium. Recall our explanation. A bond may be issued at a premium or at a discount or at par. Now, this bond is issued at a premium. Now, let's look at the redemption value. Redemption value is at par. That means at the end of 3 years, the value of the bond will be 1,000 naira. We can now explain. We can now explain now. Back to the question. Please look at the explanation. The bond, look at the explanation here, please. This is the explanation now. The bond is a premium bond. Generally, the price of a premium bond falls with passage of time, holding interest rates constant. Generally, the price of a premium bond will continue to fall with passage of time. The reason for this is that at maturity, the market value of the bond must equal the face value. You know, at maturity, the bond will be redeemed at 1,000 naira. That means at maturity, market value equals face value. So the market value of the bond will continue to fall. The market value of that bond will continue to fall. Thus, the market value of the bond at the end of year 1 will be less than the current market value now. Currently, the value is 1,059. At the end of year 1, we expect the value to fall. At the end of year 2, the value will still fall. At the end of year 3, the value will now become face value 1,000. So your response is the market value of the bond at the end of year 1 will be less than the current market value of the bond, because that bond is issued at a premium and is going to be redeemed at face value. That is the expected response to that question. You know, I've explained the aspect of increase. If there's increase in interest rates, the question we solve. Go and look at question number 2. That question on Kazauri. I explained that. If there's increase in interest rate, value of bond will fall. And if there's decrease in interest rate, value of bond will rise. All right. Any question, please? The last aspect of the question for 7 marks. Examiner says estimate and interpret the modified duration of the bond. Identify the key limitations of modified duration in bond analysis. Let me also say that this is the first time question on modified duration is coming. To me as a lecturer, I understand now that ICANN is going to other aspects of bond valuation. Bond valuation is very wide. Okay. How do we calculate modified duration? What is modified duration? First, let's deal with the calculation. And we have explained this. Modified duration is closely related to duration. It is used to measure change in the price of a bond where there is a small change in interest rates. I'll take that again. Modified duration is closely related to bond duration. It is used to determine change in the price of a bond when there's small change, when there's a small change in interest rates. Modified duration is calculated as shown below. Please, let's go to the computation. That will take me to below now. If you are enjoying lecture in your bedroom. Just 1 minute. I'm trying to enable AI. All right. We have introduced a new whiteboard. Oh, it's not flow. No, it's not enough flow. I should use this. Sorry. I will not flow. All right. We have a new whiteboard. Look at how to calculate modified duration. B3. Modify duration. It is shortened MD. MD. The formula is duration divided by 1 plus y. Your y is the YTM. We have computed the YTM to be 6.8%. Now we need to calculate the duration first. For you to calculate modified duration, you must compute the duration first. To calculate modified duration, you must compute the bond duration first. How do we calculate bond duration? We have 3 steps. First, you are going to calculate the bond yield to maturity. Then you are going to use the yield to maturity to discount the cash flow from the bond. Then you are now going to use your notation to derive your duration. Now let's go to this quickly. I'll come here, duration of the bond, the duration of the bond. I will open my table, year 1, 2, 3. I'll pick my cash flow for year 1, 90, 90, 1,090. Now my discount factor, my discount rate is the YTM. The YTM is 6.8%. Please give us the discount factor year 1, year 2, year 3 at 6.8%.
Year 1, 0.936.
936.
36.
2.
0.877.
877. 7. Year 3.
0.821.
821. Thank you. Please get the present value.
$84.24.
84.24.
Yes, sir.
84.24. Next.
78.93.
78.53.
93.
Oh, 93. 0.93. Next.
894.89.
894.89. Now the last column, present value multiplied by N. Your N is your year. Year 1 multiplied by the present value. That will give me 84.24. Year 2 multiplied by the present value. 2 multiplied by 7.
86.
15.
7.86.
7.86. 3 multiplied by the present value.
2684.7.
2684.7. Thank you. Now sum the present value. Also sum the present value multiplied by N.
The last one, 2927.
2927 points.
No, it has been approximated. Or
Okay.
296.8. So
2926.8.
2926. Two nine two six 0.8. Next.
1058.1.
1058.1. We can now get the duration. Our duration,
926.8.
without wasting time, is equal to 2926.8 divided by 1058.1. That will give us
2.77 years.
2.77 years. Thank you. We have gotten the duration. So I can calculate modified duration now. MD is equal to 277 divided by 1 plus 0.068. Your Y is your YTM. So our MD, what is the MD, please?
MD is
2.59. Please reconfirm.
Yes, sir.
Thank you. Please, it's going to be in percentage. 2.5.
Okay.
We have gotten the modified duration. Examiner says estimate the modified duration. Then explain the meaning of modified duration. Also, tell us the limitation of this modified duration. So we have answered the first part. We have computed modified duration. We need to explain modified duration and the interpretation of what we have calculated. Let us go back to the question. Look at it. Estimate and interpret modified duration of the bond. Then next, identify the key limitation of modified duration in bond analysis. Look at the explanation, please. Modified duration measures the change in the value of a bond in response to a change in 100 basis points. You can ignore that. In response to a change, in response to 1% change in interest rate. Because if I say 100 basis points, to compute basis point to percentage, 100 divided by 100 give me 1%. So you can ignore that 100 basis points. Now explain that modified duration measures the change in the value of a bond in response to 1% change in interest rates. In this example, if interest rates increases by 1%, the price of the bond is expected to fall by approximately 2.95. .95%. Please remember, if there's increase in interest rates, value of the bond will fall. So if the interest rate increases by 1%, the price of the bond is expected to fall by approximately 2.59%. Alternatively, if the interest rate falls by 1%, the price of the bond is expected to rise by approximately, that is the approximately 2.59%. So you have explained the interpretation. That 2.59% computed. It means that if interest rates should rise by 1%, the price of the bond will fall by 2.95%. And if interest rates should fall by 1%, the price of the bond will increase by 2.95%. The modified duration is only a linear approximation of the full price change. That modified duration is only a linear approximation of the full price change due to change in interest rates. It does not consider the convexity of the bond. When we say convexity, the particular characteristic of the specific bond in terms of expiring dates, amount of coupons, the payment dates of the coupons, redemption price of the bond, amortizing of the nominal redemption value, if any. the modified duration does not consider the characteristic of the bond. It is only an approximation. So this paragraph is talking about the limitations of modified duration. In addition, the modified duration is only a good approximation of bond price change. Only if there is one, it is assumed that the yield curve is flat. That modified duration is only an approximation. It is based on the assumption that our yield curve is flat, but in reality, the yield curve is not flat. When we say yield curve flat, look at the coupon rate now. Sorry, look at the spot rate. Let me show you what the examiner is trying to explain here. Our coupon rates, I think I should say it here. Look at it. Look at the spot rates. In year one, 4.76. In year two, there's increase to 6.21. In year three, the spot rate moved to 6.82. That means this spot rate is not flat. It's not the same every year. The longer the maturity, the higher the rates. So that modified duration we have computed is based on the assumption that the yield curve is flat. Number two, it assumes that there's just a small change in interest rates. Only small change in interest rate is considered. Number three, a parallel shift of the interest rate curve. That means the interest rate curve will not meet themselves. It's a parallel line. Lastly, an instantaneous interest rate change is considered, not gradual. The interest rate will change instantly, not gradual changing. All these assumptions are not realistic. Hence, that modified duration is just an approximation. It will not give us the exact change in the value of the bond. It will not produce the exact change in the value of the bond. All right, we are done with the question. We have spent like more than 1 hour. To wrap up this topic, we have solved core question for you. I solved question 1, 2, 3, 4. Please, although it's not mandatory, please attempt question 5. To tell yourself the extent to which the discussion of modified duration, the extent to which you understand. Let me even look at that question 5 very well. It's actually FAMAD, all this TK, nothing like TK. The question is about FAMAD. Please, anywhere you see TK, you just change of name about FAMAD. Nothing like TK. Everything here is about FAMAD. So, on this note, I'll be leaving bond valuation. Our next topic is financial statement analysis. I don't even know that we are coming to online class. We have shared the materials. Just 1 minute. Just 1 minute. Look at this document. Just 1 minute, please. At least we can discuss the principle. Then when we meet on Sunday by God's grace, instead of just saying let's go home, because the truth is that the time is not waiting for anybody. Yes, the material will be shared. This material will be shared with you shortly, don't worry. Play just 1 minute. Is it my desktop? I think it's my desktop. It should be my desktop. Yeah,
The
this
one,
is.
the ones you shared here, just questions.
What do you say, sir?
I said the ones you shared the other time in the forum are just questions.
Don't worry now. I share question because my intent is to come and explain in class. So I don't want you to be incurring cost of printing too much material. You understand? The intent was that when I get to the classroom, I'm going to explain this concept, that there's no problem. So that's why I share only question. But now I'm going to reshare the material. They just allow me. You can still be in the class, no problem. I will reshare the material now. In fact, I'm going to reshare two materials. I'm going to share the bond valuation material again. I will share. Why am I sharing that material? Because there's some notes I explained there. You can pick it. I will share that. Also, I'm going to reshare the statement of financial position material again. All right, let's go to it. Let's share self. Okay. So many things to share now. Yes. Hey. No, I still have other classes. I'm trying to share some material with these guys. My desktop. It should be here. Finance.
Helping is. I'll piece. I'll go outside. I'm going to piece my go outside.
Please, you can always mute if you want to talk to your friend, though. Would that be correct? I'm not sure. Let me look at what I share. I'm not sure. It's what you needed. What you needed? I'm not sure. Let me check first. See what they needed. Okay. This is the bond valuation material we just finished. Then I'll now share the financial statement material.
Why is nobody here? You stay outside. You always working on it. So why are you there? Nobody's here. Why are you going to know?
Please, can you mute while you do your discussion? Okay, I'm going to reshare material for financial statement analysis now, containing explanation now. Done. Start. I want to even remove this. I want to take this one too. I want to take it to Word. I want to take it to PDF. Both should be in PDF. Should be in PDF. This one can go. All right. You have gotten all the material you require. All right. If you are ready, I'm ready. Financial statement analysis. Let me reduce the font. It's actually hard. Financial statement analysis. If you are ready, I'm ready. Now, let me start by saying that the topic we are looking at today, or we are starting, is a topic we can relate with. Financial statement analysis. If a client you approach, you that, look, I want to make investment decision, and I want you to advise me whether to invest in this company or not. Most likely, you are going to pick the company financial statements. You are going to subject the company financial statement to evaluation with a view to determine if it's worth investing in that company. What are we trying to say is that financial statement analysis is a skill that all accountants must have, regardless of the field you want to specialize. Whether you specialize in tax, or in audit, or in what is it called, IT audit, or in what is it called, corporate finance strategy. You must understand financial statement. Oh. You must understand financial.
I go.
Sunday, please, can you mute?
Boss, don't come.
You must understand financial statement analysis. Of course, what is financial statement? Our financial statements is the statement prepared at the end of the financial year to show the company's performance as well as the company's financial position. Financial statements. These are statements prepared by the company's directors, usually at the end of the financial year, to show the performance of the company, as well as the financial position of the company. These statements include the income statement, statement of financial position, the cash flow statements, and other statements that may be required by the law or accounting standard. This statement is prepared as stewardship reporting. When we say stewardship reporting, because there's diverse of ownership from control. The owners of the business do not come to the company every day. The owners are the shareholders. They don't come to the company every day. They don't work in the company. They have invested in the company. The owners now hired directors who is to manage the business on behalf of the shareholder. At the end of the financial year, the directors must produce a report to show the activities and the performance of the company. This report is presented in the financial statement. Now the question is, unless we subject this statement to evaluation, unless we subject this statement to analysis, we cannot truly say if the company is doing well or not. On the surface, you can see financial statements prepared, but without subjecting this financial statement to analysis, we cannot truly say that this company is doing well or not. So, what is financial analysis? How do we conduct financial analysis? You must be asking yourself questions. What is financial analysis? If I'm to carry out financial analysis, what do I require? How do I go about it? Financial analysis is the evaluation of a company financial statement. Financial analysis is the evaluation of a company's financial statement with a view to determine the company's past performance. With a view to determining the company's past financial performance, and also to assess the company's future financial prospects. We said financial analysis is the evaluation of a company's financial statement. Why are we doing this? With a view to determine the company's past financial performance. Also, to assess the company's future financial prospects. So at every point in time, you are carrying out financial analysis. There are two things you are trying to do. You are trying to look at the company's past performance. Again, you want to assess the company's future financial prospects. Typically, financial analysis involves analyzing the firm's financial statement and its cash flow statement. To analyze a company's financial statement, you can take three approaches. You have three approaches or three ways. One is what we call horizontal analysis, without wasting time here. The first is what we call horizontal analysis. You can carry out horizontal financial analysis. When we say horizontal financial analysis, it's also called trend analysis, whereby you are going to compare the financial figure in 1 year with the financial figure in another year, with a view to determining the trend in that figure. When we say horizontal financial analysis, it's also called trend financial analysis. We also call it line analysis. You are trying to look at the trend in the accounts between 1 year, between the first year and the second year. For example, I can do trend. I can do the profit achieved in 2020 compared to the profit achieved in 2021, compared to the profit achieved in 2022, compared to the profit achieved in 2023. What am I comparing now? I'm looking at the trend. That is horizontal analysis of the financial statement. You can pick your revenue figure. That's okay. In 2019, this company revenue was this. In 2020, revenue was this. 2020, you now compare revenue in 2019 with revenue in 2020, revenue in 2021. When you are comparing, what you are doing is what we call horizontal financial analysis. We also call it comparative financial analysis. You compare financial figure with the next. That is one. Number two, you can have vertical analysis of the financial statement. You can have vertical analysis of the financial statement. In vertical analysis, a significant item on the financial statement is used or selected as the base value. In vertical analysis, a significant item on a financial statement is used as a base value, and all other items in the financial statements are compared to this value. All other items on the financial statement are compared to this particular value. In performing vertical analysis of the balance sheet, for example, if I want to carry out vertical analysis of a balance sheet, I can select total assets as my base value. I can select total assets value as my base value. All other asset accounts, all other asset items will be expressed as a percentage of total assets. All other asset accounts is expressed or will be expressed as a percentage of total assets. For example, I can say cash assets over total asset multiplied by 100. Our total assets is the 100%. And that's okay. My cash assets over total assets multiplied by 100. What am I trying to measure? I'm trying to look at the amount of cash represented in our assets. If you are doing that, you are doing vertical analysis of the financial statement. I can pick inventory assets over total assets. I want to know what is the percentage of inventory in our total assets. If you are doing that, you are doing vertical analysis of the financial statement. It is also called common size analysis. This is also called common size analysis. Then the third one is ratio analysis. Are they leaving the class? The class is supposed to be 8 to 10 now. Leaving the class. So they don't even like coming to class. Look at the example now. Look at it. Look at this example now. Inventory asset over total asset. This is common size analysis. It's also called vertical analysis of the financial statements. I can do cash asset over total assets. Then the third one is what we call ratio analysis, where most students are used to ratio analysis. They are also used to trend analysis. Ratio analysis. If you look at horizontal analysis and vertical analysis, we compare figures, one figure to the another, within the same category. If you look at both horizontal analysis and vertical analysis, we are comparing figures within the same category. Like the example we gave for horizontal analysis, you compare revenue in year 1 with revenue in year 2, with revenue in year 3. If you look at it, what you are comparing is within the same category. If you look at vertical analysis, you are looking at inventory assets to total assets. Everything is assets within the same category. It is also important to compare figures from different categories. It is also essential to compare figures from different categories. This is accomplished through ratio analysis. Ratio analysis allows the financial analyst to compare figures across different categories. Under the ratio analysis, we have like 4 or 5. We have liquidity ratios. We have activity ratios. We always pay attention to 5 anyway, to 4. We have profitability ratios, liquidity ratios, activity ratios, leverage ratio. Your leverage ratio is also your financial risk ratio. Then we have market value ratio. Your market value ratio is your investor's ratio. Let us take the explanation. Liquidity ratio. We are familiar with this. Like I said, the topic we are dealing with is a familiar environment for us. Liquidity. Liquidity ratio is about, liquidity ratio measures the ability of a company. Liquidity ratio measures the ability of a company to meet its maturing short-term obligations. I will take that again. Liquidity ratio. This ratio measures the ability of a company to meet its maturing short-term financial obligation. That means the company must maintain some level of liquidity. You must have some amount of cash to run your business. You are going to pay salary monthly. You are likely to pay for other expenses on a daily basis. That means you must maintain some level of liquidity. You are likely to pay your trade creditors. If you buy material on credit, you are going to pay maybe 2 months later. That means you must maintain some level of liquidity. You are going to pay your interest on your loan. If a company is having problem with liquidity, where there's liquidity problem, that company may be liquidated. Imagine not paying staff salary. They can go on strike. They can stop coming to work. If you are not paying your supplier regularly, they can stop supplying you products. Under liquidity, we can look at different ratios. Under liquidity, we talk about current ratio. Your current ratio is current assets divided by the current liabilities. It is used to measure the ability of an enterprise to meet its current liabilities out of its current assets. Current ratio is used to measure the ability of an enterprise to meet its current liabilities out of its current assets. We have acid test ratio. Our acid test ratio is a stringent test of liquidity. Under the acid test, it's assumed that inventory cannot be converted to cash easily. To calculate your quick ratio, is your current asset minus inventory divided by current liability. So you can use liquidity ratios to assess the performance of a company. We also have solvency ratio. That is leverage ratio, number 2. I've brought these two together. I want to explain them together. Your leverage ratio is also called your financial risk ratio. Solvency is a company's ability. The solvency ratio measures the ability of a company to meet its long-term financial obligation as they become due. You know, when we look at liquidity ratio, your ability to meet your short-term financial obligations. If you get to solvency ratio, it measures the ability of a company to meet its long-term financial obligations as they become due. Analysis of solvency concentrates on long-term financial and operating structure of the business. What we are saying is, if you are trying to measure solvency ratio, you are going to look at the company financial structure, your capital structure. This is where we look at the degree of debt, in the company capital structure.
Yeah.
That is our gearing, the gearing ratio. The gearing ratio, the degree of debt in the company's capital structure. We can use that to measure what our solvency ratio. So the ratio to be computed here, ratio. Our debt ratio is equal to total liability over total assets. You want to know percentage of our asset, that or our liability in our assets. It compares total liability to total assets. It shows the percentage of total funds, percentage of money we have gotten from that we have borrowed from creditors. So you can use debt ratio to assess solvency ratio. We also have debt equity ratio. Long-term debt over shareholders' funds. Who is this Chima? No, he's not even aware his speaker is disturbing us. You can look at debt to equity ratio. That's our long-term debt over us, shareholders' funds. We also have the interest cover ratio to assess the degree of financial risk, the degree of solvency. You can look at interest cover ratio, computed as earnings before interest and tax, divided by the interest expense. We also have the cash coverage ratio. Our cash coverage ratio is to address the problem of interest cover ratio. The problem with interest cover ratio is that it's looking at profit before interest and tax. But that will not represent cash. Your profit before interest and tax is not a measure of cash available to pay interest. You can calculate your cash coverage ratio. In this case, you are going to use earnings before interest, tax, depreciation, and amortization. Depreciation is a non-cash flow, add back. You can calculate your cash coverage ratio. I know that most students are familiar with interest cover ratio, but I'm not sure that they are familiar with cash coverage ratio. What are we trying to test? We want to test the ability of the company to be able to pay its long-term financial obligation. Then number 3 discussion, profitability ratio. Of course, at any point in time, the financial health of a business is measured by the profits. At any point in time, the financial health of any business is measured by the profits generated. An indication of good financial health and how effectively the company is being managed is the company's ability to earn satisfactory profits and return on investment. Profit is the primary measure of the performance of any business. Where investors will be reluctant if it does, the company is not achieving enough profits. Investors will not be willing to put money in that business. So we must consider profitability ratio.
Yeah?
What are the ratios here? You have.
That's where she dropped it. She realized she don't stop also.
That's something like phone. I
don't even know the password, sir.
I don't know. A guy asked, I should know what
Jude, okay, please, can you mute? I'll even talk to them after the class. I'll talk to them. I need to get that thing right. So just remove something to let's move on. Let's go. All right, under profitability, you can talk about the profit margin, the gross profit margin. Your gross profit margin is your gross profit over revenue, over sales. When we say profit margin, profit over revenue. It's as simple as that. You are trying to assess profit over revenue. You can look at return on investment. That is return on capital employed. To measure performance, we can look at return on capital employed. Return on investment is a key, but rough measure of performance. It shows the extent to which earnings are achieved on the investment made. Your return on investment, please note, the return on investment is also your return on capital employed. That is profit before interest and tax divided by the capital employed. You can use this to measure profits. You can use it to measure profitability performance. We have return on total assets. You can compute return on total assets. Let me look at this. I'm not even missing here. Okay. Which is your profit after tax divided by total assets. You can do that. I'll come back to DuPont later. There's a concept called DuPont's identity. I'll come back to it later. But you can calculate return on assets with a view to determine the performance of the company, the extent to which the company is using its assets to generate profits, the extent to which the company uses its assets to generate what profits, can compute it. When we say DuPont, that or DuPont identity, this return on assets can be explained by two ratios. The DuPont identity is when two or more ratios are used to explain a particular ratio. When we say DuPont, please note this word. This was tested it was tested 2023, November dies, or May dies. The DuPont identity. DuPont, let me expand this a bit. I want to draw attention to this. The DuPont. Oh no, this increase. But I still have another class. I want to make sure I finish this class. DuPont is a model that uses two or more ratio to explain a particular ratio. Like this return on asset now. We can use two ratios to explain return on asset. For example, look at it. Our return on asset is calculated as profit margin multiplied by total asset turnover. Our return on asset is calculated as profit margin multiplied by total asset turnover. Look at it, please. Return on asset is equal to net profits or net income over total assets. This is equal to what? What's our profit margin? Profit margin is the net profit over sales. Asset turnover is computed as sales over total assets. If you look at this now, we are going to get return on total assets. What this means is that if you want to increase return on your total assets, then you must increase your profit margin and you must increase your total asset turnover. Two ratios will affect return on total assets. The ratios are profit margin and total asset turnover. Our profit margin is a measure of operational efficiency. Your profit margin ratio is a measure of operational efficiency. Your total asset turnover is a measure of asset efficiency. The extent to which you can use the company's assets to generate sales. That is total asset turnover. The extent to which we can use total assets to generate sales. Our profit margin is the extent to which our sales is converted to profit. We also have return on equity. You know, we are looking at profitability ratios. You can compute return on equity. Your return on equity is return on shareholders' funds. And this is calculated as what? Your profit after tax divided by the shareholders' funds. Forget about the noise. That is earnings available to shareholders. That is your profit after tax. Earnings attributable to ordinary shareholders divided by the total shareholders' funds multiplied by 100. We can compute any of this with a view to assessing the profitability performance of a company. Lastly, is market value ratio, what we call investors ratio. Please let me add this. Please note, at every business decision should be considered from the viewpoint of the owners of the business. Every business decision should be considered from the viewpoint of the owners of the business. Who are the owners of the business? The shareholders. So you must understand shareholders ratios. What are shareholders ratios? 1, earnings per share. Your EPS. Earnings per share indicates the amount of earnings for each common shares held, the amount of earnings attributable to each ordinary shares in issue. Earnings per share is the amount of earnings attributable to each ordinary share in issue. It is computed as profit after tax minus preference dividend divided by a number of ordinary shares outstanding. Number 2, please, I'm going to take like 10 minutes. Price earning ratio. The price earning ratio. Our price earning ratio shows relationship between the market price of share and the earnings per share. Our price earning ratio shows the relationship between the market price of a share to the earnings per share, calculated at market price divided by the earnings per share. A high price earning ratio is good. Please, when you compute and the price earning ratio is high, it's an indication that the investor consider the company in favorable light, in good light. If you compute your price earning ratio and the figure is very high, it's an indication that that company is considered to be what? To be very, very good. That company is considered to be in favorable light. It also means that that company is likely to generate higher earnings at future period. If you compute your price earning ratio and you have a very high figure, it's an indication that that company is likely to generate higher earnings at future period. But if you have a low figure, it's an indication that that company is not doing well. That company is not likely to make sufficient profit at future period. Number 3, we have explained earnings per share, price earning ratio. We have earnings yield. Under investors ratio, we have earnings yield. Earnings yield is a measure of potential return on shareholders' investment. Earnings yield is a measure. It shows potential returns on the shareholders' investment. It is calculated as earnings per share divided by the market price per share multiplied by 100. Next, dividend per share. Dividend per share shows the amount of gross dividends that is attributable to each ordinary shares in issue. Dividend per share is the amount of gross dividends on every issued ordinary shares, calculated as our gross dividend divided by the number of ordinary shares. Next, dividend payout ratio. Our dividend payout ratio. Our dividend payout ratio is the percentage of the company's profit that is paid as dividend to shareholders. Dividend payout ratio. This is the percentage of the company's distributable earnings that is paid to shareholders in the form of dividends. This is calculated as dividend per share divided by earnings per share multiplied by 100. Next, dividend yield. Your dividend yield measures the actual return on shareholders' investment. Your dividend yield is a measure of actual return on shareholders' investment. You know, we said earnings yield, measure of potential return. Dividend yield is a measure of actual return, computed as dividend per share divided by market price per share multiplied by 100. Lastly, we have dividend cover. The dividend cover ratio. This measures the number of times ordinary dividend is covered by profit after tax. The number of times our ordinary dividend covers profit after tax. Our dividend cover is calculated as EPS divided by DPS. Please don't multiply by 100. Dividend cover is calculated in times. Any question, please? All right. Like I explained, examiner is also bringing more to your syllabus. Not really more. It's expanding to other areas. Like this DuPont analysis. DuPont. Examiner started this last diet. When they tested DuPont, I think it was made diets really. DuPont analysis was developed, or DuPont model was developed in 1920s to explain the reason for the value or change in value of return on equity. You know that investment is about the owner. In those days, it's about the return to the shareholders. A company is only considered doing well if you are generating enough return to your shareholders. Because the shareholders has provided the money to do the business, and they can take their money away one day. So the DuPont model explains the reason for the value and change in value of return on equity. DuPont analysis is a financial model or a financial model that is used to explain the value or change in value of equity. With DuPont analysis, return on equity is calculated as profit margin multiplied by total asset turnover multiplied by financial gearing, financial leverage. It's also called gearing anyway. Examiner tested this very well. Return on equity is calculated as, can be explained by three ratios. Return on equity can be explained by three ratios. You know, I mentioned it, that the concept of DuPont is that we can use two or more ratios to explain a particular ratio. So if I'm to explain return on equity, I can use three ratios to explain this. Look at it. Return on equity is equal to profit margin multiplied by total asset turnover multiplied by financial leverage. This is equal to what? Your profit margin is calculated as the net profit divided by revenue. Total asset turnover is calculated as revenue over total assets. Financial leverage is calculated as total asset divided by shareholders' funds. So these three ratios will explain change in value in return on equity. The DuPont analysis is important in explaining what is driving a company's return on equity. The DuPont analysis is important in explaining what is driving a company's return on equity. Profit margin shows the operational efficiency. Asset turnover shows the asset utilization efficiency. The leverage factor shows the extent of usage of leverage, the extent to which a company has borrowed money to finance its business. That is leverage. These three ratios will explain change in equity or change in return on equity What it means is that if you want to increase return to shareholder, you need to look at your profit margin. You must increase operational efficiency. You must increase asset turnover, asset utilization efficiency. Then you must try to reduce the amount of debt. Leveraging assets more efficiently. All right. 13 minutes after, we are done with the explanation on this topic. Even though it wasn't planned that we are going to have class online, I didn't even know. But I think it's a blessing in disguise. Any question? We shall stop here. When we meet on Sunday by God's grace, I will just go to calculation. Any question, please?
No, the explanation is quite clear. Very, very clear.
All right, thank you. Just that some of you have been disturbing my class. Like this,
Sorry about that.
And like that, Mr. Steven now is going to church. He carry his Bible on the streets. I don't even know this. I don't know. I think we have to carry a pack of Bible for Steven. Almost every week, you must ask for Bible.
As in, I don't even know what is even wrong with him. But I think that is
Just
how
carry
he
one
is.
pack and bring it on Sunday. You have to help the guy.
He will still ask for pen the next Sunday.
It will still ask so.
I beg you, let's go. I'm gonna leave the man. All right.
Thank you so
for
much.
your time.
Thank you so much.
It's
All
all
right,
right.
sir.
But I have question, but it's
No,
on.
go ahead.
You know, if we are dealing with if it's on the bond valuation though.
No, that's
if
fine. Ask
the,
your question.
If the bond will not be redeemed, are we still going to use the same method? Everything as the same method that we use to compute when?
No. Let me take you to whiteboard. Let me share I don't want to use one small whiteboard to explain that. Okay, let me see if I can use this aspect. I just want a one whiteboard. No, you won't use that approach. Although it is hardly tested though, because it's too simple to do that. That one is just one way forward. Or it's just one way forward. Say that one, if they give you, everybody will get it. So the examiner hardly test that. That one is just too simple. Now look at it. If you are dealing with a bond not redeemable, okay, let's deal with that. If you are dealing with what we call irredeemable bond, that means there is no maturity date now, Abby. No maturity date.
Yes. That means there's no maturity.
That means you are going to get interest forever. You continue to get interest from year 1, year 2, forever. Look at the value. The value is calculated as value is equal to interest divided by the yield. That's all. So if the interest annually is 90 and the yield is, say, 6%, then I'll just do 90 over 0.06. That's all. That's all. Examiner will not test this one. It's just like saying you are calculating present value of a cash flow to infinity. How do you do that now? The present value of a cash flow to infinity is equal to the cash flow divided by the discount rate. Is that not? It's that same thing.
Yes.
How that is clear?
Okay. Yes, sir. I
So if
also
you
want to ask the material.
the material, yes, that line is breaking.
The one you use. You know, I was not in your class last weekend, and I didn't quite get as in the first part you
Oh,
were
you missed the
explaining.
class. Ah.
Yes, I was at work that day, so I couldn't attend that. So the material you sent, does it contain the solution of, as in from the beginning?
That material, it doesn't have that solution for A because we solve it in class.
In class, oh.
Yes. It doesn't have for
Okay.
A.
Call a friend. Call a friend.
Phone a friend.
Okay, I will just get somebody to share with me so that I will use it and update
please.
myself.
No
It's
worries.
all right. Okay, thank you, sir.
Yes, sir.
All right, let's.
Hello, sir.
Any question again?
Just a very short one. This dew point analysis, sir.
All right.
From your explanation, is a combination of ratios to ascertain probably change in value of on equities.
Yes.
Now, I want to ask that apart from this return on equity, are there other ratios that these dew points can be used for?
Oh, fantastic. Originally, DuPont was used for return on equity.
Okay,
but
sir.
you can use DuPont for any other ratio. Like we did for return on assets. You know, we use DuPont.
Yes, sir.
Originally, the man that developed DuPont was looking at return on equity. But it can extend to other ratios, like we did here now. Look at when we did return on assets.
Profit margin times total turnover.
Thank you. Look how it is. We introduced DuPont to it. Return on total asset can be explained by profit margin and total asset turnover. This is DuPont now. So you can introduce DuPont to other ratios, provided two or more ratios can explain that ratio. Is that clear, please?
Yes, sir.
Like if you look at return on capital employed, it can be explained by two ratios, two or three ratios. You can use DuPont for it. The concept of DuPont is where you can use two or more ratio to explain a particular ratio. That is DuPont analysis.